Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 4th September. Coming up on the show, Apple fights back against OpenAI and Perplexity as it plans to launch its own AI-powered web search tool for Siri. Nvidia chips are still in demand in China, despite Beijing's objections. And could gold hit $5,000 an ounce? Well, that's the prediction from Goldman Sachs. So grab your coffee and let's own the morning. Well, the first thing you need to know about this morning is Apple's latest AI move, an area where it has found itself behind the competition. According to Bloomberg, Apple is planning to launch its own artificial intelligence-powered web search tool next year. Crucially, it will be integrated into the Siri voice assistant and so will compete with OpenAI and Perplexity AI. The new system will be called World Knowledge Answers and it will be able to look up information from across the internet and provide an AI-powered summary. Apple's share price enjoyed its best one-day rise in almost a month yesterday, up almost 4%. Google is currently in the lead to help Apple revamp its voice assistant, which could involve using a custom Gemini model running on the iPhone maker's servers. Now, Google parent Alphabet saw its shares rise over 9% yesterday. That was more than likely down to the legal win it achieved in its antitrust case. Okay, next up, we're sticking with the AI theme and we're talking Nvidia. The likes of Alibaba and ByteDance are among Chinese tech firms that remain keen on Nvidia's AI chips, despite regulators in Beijing strongly discouraging them from such purchases. That's according to Reuters. Nvidia only recently regained permission from Washington to sell its popular H20 chip into China and is now developing a more advanced chip, the B30A, for the country. It's said to be 6 times more powerful than the H20, but again will need Washington approval in order to sell it into China. Matching Nvidia's chips is hard, and China's homegrown chipmaker Cambricon is learning it the hard way. Cambricon shares have slumped today after the stock more than doubled last month, and some investors might be profit-taking. And the last thing you need to know about is all about Washington. The president has asked the US Supreme Court to uphold his global tariffs, seeking review in a case that could affect trillions of dollars in trade and give him a broad new leverage over the world economy. Bloomberg reports that the appeal calls for putting the case on a highly expedited schedule with arguments in early November. Also in Washington today, the president will host tech leaders in the Rose Garden. The bosses of Meta, Apple and Microsoft will all be there. Someone who won't be there, Elon Musk, the Tesla CEO. So as you can tell, it's a packed day ahead. So here's what to watch. Listen here to Yahoo Finance's Josh Lipton.
Time now for to watch Thursday, September 4th. Going to start off on the earnings front. More reports rolling in on Thursday, including Broadcom, Lululemon, and DocuSign. Broadcom announcing results for the third quarter after markets close. Analysts expecting the semiconductor company to beat Wall Street's forecast for Q3, give strong guidance for Q4, driven by continuing demand from the AI trade. Going to take a look at the Federal Reserve as well. We're going to be getting some more commentary from a couple of Fed presidents on Thursday, with John Williams and Austin Goolsbee. The U.S. Senate Banking Committee also holding a hearing to consider Stephen Moran, President Trump's nominee to the Federal Reserve Board. Moran will take over Fed Governor Adriana Kugler's seat, whose term ends in January. And finally, fresh data on the labor market coming in on Thursday with ADP employment. Economists forecasting companies to add 68,000 private payrolls in August. They'll be down from 104,000 in July, signaling a cooling in hiring.
Now let's take a moment to look at some big names in tech that reported after the close last night. One name that stands out clearly in the green in pre-market, HPE, Hewlett-Packard Enterprises. It's a clear beneficiary of the strong demand in AI-related infrastructure. HPE raised its full-year guidance to 14 to 16% as its Q3 revenue exceeded estimates at $9.14 billion versus expectations of roughly $8.5 billion. It's a very different story from Figma and Salesforce. Both companies had set very high expectations among investors with their artificial intelligence plays. But this morning, those investors are disappointed. First, Figma, the design software darling, reported its first earnings last night since pulling off one of the most successful and most hyped IPOs of the year. Remember, it shot up more than 250% in its debut, but it's been fizzling since, as you can see here in this chart coming up. Today, its shares are tumbling even as Figma delivered a 41% year-over-year revenue growth to $249.6 million, along with improved profitability. Why is that? Well, the number we're not seeing as exceptional enough to justify that sky-high valuation. On top of questions about growth prospects, Figma faces an imminent lockup expiration, with a wave of employee-held shares becoming eligible for sale. Turning to Salesforce. Now, shares have slipped quite a bit in pre-market, down nearly 7%. The global giant in enterprise software and AI integration just slightly beat Q2 revenue expectations, but its Q3 revenue forecast came in below Wall Street targets, raising alarms over the speed of AI monetization through its Agentforce platform. This suggests investors are growing impatient with how quickly Salesforce can convert its AI investments into real revenue, especially amid uncertain macroeconomic conditions and cautious client spending. Now, Jefferies senior analyst Brent Thill spoke to my colleague Josh Lipton last night, explaining that Salesforce is underperforming in comparison to its peers like Oracle, Microsoft, and Snowflake.
It was in line. It wasn't better than expected, and you need better than expected when the AI narrative right now is that it's going to eat all applications. So, don't hate the player, hate the game. The game right now is you got to get north of 10% constant currency backlog, and they hit 10%. Half their customers in Agentforce are paying. It's not having the material driver for growth, and they're guiding, to high single-digit growth. And so, if you look at every large cap software name in our coverage universe, Salesforce is the slowest growing of them all.
Brett, Salesforce does have AI products, and I'm sure if Mark Benioff was here with us on set, he'd tell us all about them. Is the problem here that they're just not compelling right now, as compelling as investors hope they would be for customers?
I mean, they're in their infancy. We've talked about AI and applications versus AI and infrastructure. I mean, all the attention's in infrastructure. Microsoft, Oracle, Nvidia, go through the list, right? Where are all the numbers inflecting in infrastructure? What happened here? No inflection. So, look, everyone has an AI story, but the reality is the actual impact has been not material to the revenue yet. It will be for Salesforce as we go into next year and the year after, but we're talking about years. We're not talking quarters until it's material. And that's the challenge. Again, when you see inflections in Azure inside Microsoft, you see Oracle's backlog at 100% growth. We're talking 10% constant currency backlog. Just to put this in perspective, Snowflake's growing 30, right? We can go through all the lists, like all the numbers relative to its peers, they are underperforming. So yeah, Brett, it's not bad. It's not bad. No one's going to say these are bad numbers. We're just playing a relative game where everyone else in a relative basis, Josh, are way better. And that's why you're seeing Microsoft stock up, Oracle stock up, all these other stocks are down. The reason why Salesforce stock is down 20+% is that there is no inflection. There's a worry that Benioff's going to go out and do a lot of M&A, and there's been no inflection in the numbers. I mean, again, we're talking the slowest growing large cap name. Oracle's going to grow faster than Salesforce. So we're not negative Nellies. We're just, the point is when you put it relative, they're the slowest moving vessel in software right now.
Time for our first break, but stay tuned to Yahoo Finance to hear how Wall Street is braced for the upcoming jobs report. Welcome back. Well, this week, Wall Street has been bracing for a string of employment data. Let's hear now from Stephanie Roth, Wolfe Research chief economist. She spoke with Ali Kanal about what markets can expect from the August employment report due out on Friday.
It does paint the picture of a slightly softer labor market. The layoffs rate in particular, that said, the prior month was also revised up. So the layoffs rate ticked up versus consensus, but the prior number was also a bit higher. The picture is a labor market that has softened quite a bit, but it's not necessarily weak outright. So it looks like layoffs are still fairly contained, and it's really just a low hiring, low firing environment, in which case, it's a more challenging environment for the Fed later this year. So it certainly looks like the Fed's likely to cut by 25 basis points in September. Beyond that, it becomes a little bit more challenging as the labor market, rebounds a bit from what we're seeing in the summer. Our expectation is it looks better later in the year. And then you start to see inflation pick up a bit. So the narrative could get a lot more challenging than it is today, which is sort of dovish price action.
Mm-hmm. Now, looking ahead to Friday, payrolls are expected to once again slow, and you're calling for 70,000 jobs added. This is slightly below consensus. How significant is it if we continue to see payroll numbers below 100,000? Is that just the new normal, especially considering the immigration crackdown and this low hire, low fire environment that you were just mentioning?
Yeah, it kind of has to slow down. If we were running above 100,000 jobs, that would be an issue because there's just not the labor supply to support that. So it should slow down below that 100,000. Somewhere in the 70, 80,000 range is kind of the steady state payrolls environment. It seems like the earlier months were a reflection of extreme economic uncertainty, particularly tied to tariffs. On top of that, there were major changes that happened from an immigration perspective. So that led to some significant weakness over the summer. We do expect later in the year, you're going to get a bit of a cyclical rebound and you'll start running closer to that 70,000 trend, which is really something that's quite solid and a signal that the labor market is in a decent balance. So our expectation is while we might get some softness in the most recent report, 70,000, but also some potential downward revisions to the month of July. You also get the preliminary annual revisions on September 9th. Then beyond that, the narrative might shift. So this dovish narrative may remain in markets for the next couple of weeks. But beyond that, we actually think that you'll see kind of similar to what you saw last year, where the dovish narrative gets priced out a little bit and it becomes a little bit more, not necessarily hawkish, but certainly less dovish than what's in the price.
How closely do you think the Fed pays attention to all of these revisions, especially as you just laid out? We might see more revisions to July. We have the September 9th annual revisions. How much could that change the calculus when they're thinking about rate cuts?
Yeah, so the revisions to July could surprise folks just because they're going to be looking at the most recent 3-month run rate, and to the extent that July ends up being softer than the 73,000, that will be certainly important for the Fed. In terms of the annual benchmark revisions, we largely know that because we get the QCEW data that is linked to the unemployment insurance records. That's what they use to do these revisions. So we already know that data. We know it's going to be revised down somewhere in the 400 to 600,000 range. So that shouldn't have a big impact in terms of the Fed's thinking. That's also backward looking. That's for the period from April of 2024 to March of 2025. So I would say the annual benchmark revisions aren't important for the Fed, although it might catch the market's attention. The revisions to the most recent 2 months in terms of payrolls, that will be quite important.
Mm-hmm. And what other metrics should investors have their eye on? Is it wages? Is it the unemployment rate? What are you focusing in on Friday?
Yeah, the unemployment rate is going to be important, largely because that helps to offset in terms of the numerator and the denominator calculating that. Mm-hmm. It helps to offset what we're seeing in terms of immigration. So that is, certainly what the Fed is targeting and focused on most closely. So something like a 4.2 would make the Fed feel a little bit more comfortable about the backdrop. If it happened to rise to 4.4, which is not our view, we're looking for a 4.3. That would get the Fed a little bit more concerned about the labor market. So unemployment rate is most important. And then secondly, they're going to be looking at the trend in payrolls growth, even though we know that there is an impact of immigration and it's a little bit hard to measure how much. If we get a number that's around 50,000 or below, they would start getting a little bit more concerned because that would just validate the slowing trend. It wouldn't concern us so much because we do expect that immigration has had a big impact on the labor market, but it certainly would get the attention from the Fed because they're risk managers and they have to ensure that the labor market isn't getting weaker than that, even if it's not their modal or base case.
And you were just saying the call for September, how we will likely see that rate cut later this month. But beyond that, there's a big question mark. How worried are you about stagflation risks, especially if we're in a market where the labor market is slowing considerably and we do have persistent high inflation? When you look at stagflation and the Fed potentially cutting, how do you square the two?
So when we talk about the tariffs being stagflationary, I would say it in a very mild sense because we're talking about inflation running above 3%. We're not talking about inflation 6, 7, 8, 9%. So it's an elevated sticky inflation, but it's not something that's overly concerning. It's just a problem for the Fed. And then from a growth perspective, similar thing. Growth is running around 1.5% this year. It's a lot slower than where it's been, but it's not zero and it's not negative. So while it has sort of stagflationary dynamics, it's not sort of stagflation in the true sense. So we are worried about that. So to some extent in directionality, we do think inflation will be a little bit more elevated. Where we are a bit different from consensus is our expectation is that growth will start to pick up again. And that a lot of the reason why we've seen such sluggish growth most recently in the past couple of months has been more a function of tariff uncertainty. As that uncertainty starts to fade, just because we have a little bit more clarity on kind of where tariff rates are going to settle out roughly, looking ahead, economic activity could resume and we'll see a better environment from both consumers and businesses.
Time now for another break, but we'll be back soon for today's Trending Tickers. Welcome back to Market Sunrise. We are now doing our trending tickers, and our first trending ticker today is American Eagle Outfitters. The ticker there is AEO. Its shares soared more than 25% in after hours following its earnings report. It's now trading over 26% higher in pre-market now. What's behind the pop? In short, the brand has got an unprecedented momentum with Gen Z customers despite shaky consumer sentiment right now. American Eagle lifted its outlook. The company now expects low single-digit gains in Q3 comparable sales and flat full-year comparable sales, a sharp turnaround from prior expectations of declines. And in the past 12 months, the stock is still down more than 30%. The outfitter appears to have benefited from a controversial marketing campaign featuring Sydney Sweeney that went viral, even as it faced criticism. American Eagle doubled down on its messaging, highlighting Sweeney's personal story and playing on the words jeans, the trousers, and jeans, that's Genes. Okay, and speaking of viral campaigns, take a listen to this.
Nothing beats a Jet2 holiday. And right now, you can save £50 per person. That's £200 off.
Yes, our second trending ticker is Jet2. The UK-based tour operator had one of their adverts backed by vocals from British artist Jess Glynn go ultra-viral on social media for perhaps the wrong reasons. Well, the company has warned that its profits are going to be at the bottom end of analyst forecasts and has already cut the number of seats available on its destination holidays from 5.8 to 5.6 million. Shares are currently down over 14% on the London Stock Exchange. The company has experienced major brand awareness with their viral content, but cautious consumers appear to be holding back from booking their big getaways. The effects are being held on both sides of the pond, with hotel chains Marriott and Hyatt, as well as airline Southwest, also forecasting delays in bookings. Now, our third trending ticker is Tesla's biggest rival in electric vehicles, China's BYD. Like Elon Musk's company, the Chinese EV maker is also under pressure today. Hong Kong-listed shares of BYD are in the red this morning after the company cut its 2025 sales target by as much as 16%, down to approximately 4.6 million units. That's according to Reuters. Quite a few reasons for the adjustment: cooling domestic demand, intensifying price competition, and slimmer margins are the main ones. And this comes as BYD posted its slowest annual growth since 2020, delivering modest year-over-year sales increases and absorbing a 30% quarterly profit drop. This news certainly won't go unnoticed in the electric vehicle world, where expectations have been sky high, and BYD has been a big beneficiary of that optimism. But just in the past few days, slowing sales for Tesla and the end of some generous subsidies are raising fundamental questions about the future. Well, today's call of the day is on gold. The precious metal could rally to almost $5,000 an ounce if the Federal Reserve's independence were damaged and investors shifted just a small portion of holdings from treasuries into bullion. That's the call from Goldman Sachs. The bank outlined a range of possible outcomes for the metal, with a baseline forecast for a surge to $4,000 announced by mid-2026, a so-called tail risk scenario of $4,500, and an estimate of almost $5,000 if just 1% of the privately owned US Treasury market were to flow into gold. Now, bullion has been one of the strongest performing major commodities this year, rallying by more than a third and hitting a record earlier this week. The advance has been powered by central bank accumulation and bets that the Fed will soon start to reduce US interest rates. Additional support has more recently come as President Trump has moved to assert greater control over the Fed, including a push to oust Governor Lisa Cook. Now, Goldman's note didn't talk about the recent developments at the Fed, but it's clear that the challenges to the US's central bank are growing. In fact, even the European Central Bank President, Christine Lagarde, has warned that the Fed losing its independence would pose a, quote, serious danger to the world. Well, if there's one thing all central banks have been worried about, it's inflation. But George Bory, chief investment strategist at Allspring Global Investment, has a different view when it comes to the Fed's inflation target.
Inflation's above target, but it's not wildly out of the range from the Fed's perspective. The Fed's job is not necessarily to get to 2%, but to have the market believe that they will eventually get to 2%. So their time horizon is not tomorrow, but it is over time. So we think there's room to cut rates. They don't need to cut fast and furious. They can cut a little bit and see how the economy starts to unfold. But there's certainly scope and rationale for the Fed to start easing at a pretty slow and measured pace. And that seems consistent with what the Fed Chairman Powell has said and other Fed governors as well.
Well, let's get a final check on futures before we go. And US stock futures are mainly just above the flat line. Yesterday's JOLTS report has really amped up anticipation for Friday's jobs report and boosted bets on a Federal Reserve rate cut this month. Remember, stocks mostly closed higher on Wednesday after the latest update on jobs openings indicated continued softening in the labour market. Remember, the ADP report for August measuring private payrolls is expected at 8:15 a.m. Eastern and a weekly reading of jobless claims at 8:30 a.m. Eastern. Let's turn to Europe now. And markets mainly were in the green. It's just the CAC 40 that's bucking the trend there. Lots of political upheaval in France there and whether they can get their budget through there. And finally onto Asian markets. And Asia Pacific markets mostly closed higher today following a tech rally overnight on Wall Street. In Japan, domestic tech stocks also gained. They were led by SoftBank, which advanced over 6%. Shares of Nvidia supplier Advantest also over 4.5%. But just look at China there. A sell-off in Chinese stocks deepened off a report that regulators may move to cool a rally that has added, get this, $1.2 trillion since August. Okay, well that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join me ahead of the market open on Morning Brief, so stick around for that. I'm Ramzan Karmali. Go own the morning.